Hi folks, welcome back to Meaningful Money. This time we're finishing off our discussions about the foundations of financial planning. Remember in the introduction to this section I talked about the Lipsey scale: life, income, pension, savings and investments. What we've dealt with is life so far in the different kinds of life assurance and critical illness insurance. Now we're on the I, the income protection. If you imagine, if you think about your assets, what it is you're worth. You may have a beautiful house, you may have a mortgage set against it, but maybe not. You may have a yacht on which you can sail the beautiful ocean behind me. You may have, I don't know, a fantastic set of golf clubs. But I imagine your biggest asset, if you think about it, is your ability to earn an income. Depends what age you are, of course, but if you think that I'm 35 and I'll work till I'm 65, that's 30 years worth of income potential. Now, assuming, as is logical, that my income will go up a little bit each year, then if you add that up, then my capacity to earn a living is probably my biggest single asset, the thing of most worth that I have. But if I go sick tomorrow, long term, then that capacity to earn is wiped out overnight. Income protection insurance is designed to insure against that happening. So how does it work? Well, first thing to say is that it's a term policy. Do you remember? It has a set beginning and end point, so that if you don't claim on it within those 2 points, you won't get anything back. It's just a term assurance policy. Now, it's not a lump sum benefit like the life assurance policies and the critical illness ones we've talked about. Instead, because it's designed to replace an income, it pays out a regular income. The amount of that income can be set, but there are maximums, as you can imagine. But it's designed to cover you if you can't work due to accident or illness. Now, is there any caveats to that? Well, yes, there is, but not that many, really. It doesn't really matter why you're off sick. It could be a bad back. I know people who've been laid up for years due to bad back, sciatica and things like that. Or what about chronic fatigue, where I have a friend, a very good friend, who has had chronic fatigue for well over 10 years and hasn't been able to work in that long. And that puts a real dent in their household income. Income protection is designed to cover that. So it's a term assurance policy. It's designed to cover accident or illness. People walking on the footpath behind the camera looking at me. What else to say about it? Well, firstly, there is a deferred period. Let's say I go sick tomorrow. Well, I can set a deferred period. Don't worry about me, not talking to myself, talking to the camera. I could set a deferred period, and what that means is it's a length of time between me going off sick and me putting a claim in and the policy actually paying out. Now, that can be 4 weeks, usually is the minimum, 13 weeks, 3 months, 26 weeks, 6 months, 52 weeks, a full year, and even sometimes 104 weeks. Well, why would you do that? Why not have it paying out from day one? Well, 2 reasons. Maybe if you work in the public sector, let's say you're a nurse or a teacher or working for the local government or something like that, chances are if you've been there a while, you'll have pretty good sick benefits, maybe 6 months full pay, sometimes even followed by 6 months half pay. Well, you could then set your income protection policy to pay out after 6 months, because you're getting full pay anyway for the first 6 months from your employer. So that's why you would choose the deferred period. Another reason, though, remember, is the likelihood of you claiming on the policy goes down the longer the deferred period. You see, if I do my back in tomorrow, the odds are pretty good that I'll recover in a few weeks. So if I set my policy not to pay out for 26 weeks, it's going to have to be something pretty serious and long-lived to keep me off work for that long. And that's unlikely. And the lower the likelihood of the claim, the lower the premiums. So the longer the deferred period, the lower the likelihood of claim, the lower the premiums. So get your deferred period right. Set it for affordability and also for your circumstances if you have any sick benefits with your current employer. Now, what if you're on 20,000 quid a year in office employment? Can you set up a policy for £100,000 a year and then go off sick? You won't be surprised to hear that no, you can't do that. That would be great if you could, but we'll soon have a stop put to it. No, there is a maximum amount you can cover, and it's usually about 70% of the gross income that you were receiving in earnings before you went off sick. All right? So it's approximate, and there are some differences between different policies from different providers, but that's a good guideline. So you're going to take a pay cut if you go sick, but it doesn't have to be too severe. Remember, it's 70% of gross earnings. Normally you pay tax off that. You do not pay tax on the benefits from an income protection policy. So they're pretty valuable. Remember also what we talked about likelihood of claims, though, is that the more likely you are to claim, the more expensive it is, obviously, and we had life assurance at the outside where you're very unlikely to claim, critical illness cover next where you are more likely to claim. Given that income protection is about protecting your ability to work, and pretty much anything can affect that, bad back, chronic fatigue as we've said, then the likelihood of claim is higher than critical illness. So it can be expensive, but it is well worth it if you can afford it. Folks, I can't stress strongly enough, the reason I call this section Foundations is because it's what everything is built on. Get this wrong and you're in jeopardy potentially, or at the very least you're putting your future at risk. Get this right and you can build on top of it with the sure knowledge that you're going to be okay pretty much what happens. One last thing to say about income protection. The definition I said about caveats of whether you're off sick or not, there are two definitions of that. One is that you are unable to do what's called your own occupation. That's specifically the job you were doing before you went sick. Now you have to be careful there, because if you can't do your job, but you can do another job, then maybe the policy could either refuse to pay out or pay out a lower amount, or just make up the difference between your previous job and your new job. So I mean, it's possible, for example, if you were a steeplejack before and fall off and break your pelvis and never walk again, well, you may be able to get an office job after that because you can still use your arms and all that sort of thing. You need to be careful about that. Usually the higher risk occupations, so if you're a steeplejack, let's face it, you haven't got a cat and mouse chance of getting income protection insurance, but if you have a reasonably risky job like a fireman or something like that, then no, it's very risky. You probably wouldn't get it then either. But the riskier your job, the more likely it is they will impose an own occupation definition. The alternative is if you're a desk jockey like me, sat on my ass all day behind a desk, then I might probably get an any occupation definition, which means that it'll pay out as long as I can't do any job. So it's careful. You need to be careful when you're arranging income protection that you cover that off. Now, anyway, enough rabbiting from me. Income protection is important. We're going to be moving on now. We've dealt pretty much with foundations. I think I've covered it all. I almost certainly haven't, so I will probably have to put some comments in or even addendum to this video. Hope that's been useful. Leave any questions or comments and I'll do my very best to get back to you as soon as I can. Thanks very much and see you next time.